I'm Anthony Valeri, Director of Investment Management at Zions Wealth. Thanks very much for joining, everyone. Today, we'll go over our 2025 economic and financial market outlook. We'll have time at the end of the prepared remarks to answer questions. So let's go ahead and get started. We'll begin with the economy, and GDP growth exceeded expectations for several of the prior quarters. You can see that here with the dark blue lines. And only the first quarter of 2024 saw a below expectation growth rate. As we look to 2025, or the end of 2024 and 2025, expectations are relatively low for economic growth. That slowdown is expected. The fourth quarter growth expectations have already started to come up, and we think the bar for 2025 at a 2% growth rate is relatively low. We actually think the economy can grow a little faster than that as we continue to see underlying momentum propelling the economy forward, and we do not see a recession unfolding. Let's move to why that's the case. And it starts with the consumer, who has been a workhorse for the economy and will continue to drive the economy onward. The consumer spending has been very robust, usually exceeding expectations, and has been a key driver in moving the economy forward and often exceeding those growth forecasts. Here you can see US retail sales indexed to 100 back in 2000. Note the pre-pandemic trajectory and the fact that sales have exploded post-pandemic and maintained an above-trend trajectory. So the consumer continues to do their part. We're not seeing a slowdown amongst the consumer in terms of propelling the economy forward. And when you think about the consumer and its impact on the economy, you can't help but also think about wealth effects and their general financial well-being. Rising equity markets, rising housing prices, rising housing wealth, wage gains, all of that has helped fuel a steady advance in household wealth, which in turn has provided confidence for the consumer to keep spending. This is data from the Federal Reserve. You can see the steady increase in household net worth. At the same time, consumers and corporations, while we're at it, did an excellent job of refinancing their higher interest rate debt and locking in lower interest rates. That has helped keep overall costs low. Even though rates have increased, it has not affected the broader consumer. So the consumer remains a driver in the economy. And we don't see that changing unless we see changes in the labor market. While the labor market has slowed, we're not really seeing any signs of broad weakness. The labor market remains resilient. Here we show monthly payrolls, and the last report in December was stronger than expected, showing a gain of 256,000 jobs. That has caused the 6-month moving average to tilt higher. That is 48 consecutive months of positive job growth. And it's, again, until we see some weakness in the labor market, some outright job losses, we do not see any weakness driving consumer, or any resulting in weaker consumer spending. The unemployment rate remains quite low at 4.1%, even if up from the recent lows. One of our first early warning signals on the labor market would come from weekly jobless claims, but here too, there's been much anticipation we'd see an increase in weekly claims, simply not coming to fruition. And weekly claims remain historically low through the end of 2024. There are signs that the labor market is cooling. We see, although layoffs remain very limited, the long-term unemployed as a category within the labor market data has slowly increased, and the voluntary quit rate, which is part of the JOLTS report, shows that new hiring is slowed and workers don't have the confidence as much as they did previously to switch jobs. So while workers haven't been fired, new hires are down considerably. So we're getting into better balance in the labor market, but again, not outright weakness that would erode the consumer spending driving the economy. Also helping the broader economy via the consumer is lower inflation. We've seen a steady decline in inflation as measured by the CPI index and other measures of inflation. Now, the overall CPI, which is the dark blue line, has blipped higher in recent months due to higher energy prices. But the Fed are most closely watching core prices. That's the lighter blue line, which after a recent increase fell again. It was released last week, a slight deceleration, which likely gives the Fed confidence to cut rates again in 2025. We'll get back to that in a moment. But the declining inflation is going to be a plus. And when we look at the green line, which is a measure of housing inflation, owner's equivalent rent, that too has been declining with a lag. So when we look at CPI inflation, we see a downward trend, even if the pace of those declines is likely to slow significantly in 2025. So we do see downward pressure on inflation, do not see a resurgence in inflation forthcoming in 2005. So we do see the Fed following through with 2 rate cuts later this year. So all of that is in place to help provide a solid foundation for the economy, which should help financial markets. And let's turn to the equity markets. Now that we've reviewed the economy, the S&P 500 in 2024 had another year of very concentrated performance. So it was a good year for the S&P 500 overall, up 25%, but only 29% of stocks within the S&P 500 actually outperformed the broader market. This is a repeat or a very similar outcome to 2023, where again, a limited number of stocks outperformed the broader market. You have to go back all the way to the late 90s to see a similar outcome. What this means is that diversification basically didn't work for investors in 2024, even though markets were generally favorable across the board, but trying to match the gain of the S&P 500 wasn't possible without that concentration. Here's another way to look at it. Looking at all of the companies in the S&P 500, 146 outperformed while 352 underperformed. Shows you the breadth of negative performance in the index, a reminder to stay diversified. And this is a challenging market for diversification. In fact, 46% of the S&P 500's return last year was generated by just 5 companies: NVIDIA, Apple, Amazon, Google, and Broadcom. So again, a historical rarity to see that kind of concentration. We're looking for that to broaden out, and we'll talk more about that in a moment. When we look at valuations, you'll see that you see that the Magnificent Seven, part of those stronger performing equities, having the highest valuations in the market, whereas the S&P 500, the market cap index, is the blue line. The forward PE ratio there is elevated relative to history. That's an indication of an expensive market, and no doubt valuations remain elevated, and that means a lot of good news is priced into the market. However, if you look at the lighter blue line, which is the S&P 500 equal weight, a much more reasonable valuations that is roughly in line with the historic average. So while we do see lower returns for the equity markets broadly in 2025 due to those higher valuations, we certainly don't see the broader market grossly overvalued. In fact, see it fairly valued, and why we'd continue to invest in stocks and maintain that equity allocation. Now, why do we suggest remaining diversified and not chase those higher performing stocks at the top? Well, we see profits, namely here, income growth narrowing between the Magnificent Seven, those big tech stocks that have dominated performance over the last 2 years. We saw some of this reversion back in the third quarter of 2024. It did not stick for the final quarter of 2024. But as we move forward, you can see here that profits are expected to narrow, or the gap between those two sets of companies is expected to narrow. And that should lead to better performance, in our view, between the broader market and the Magnificent Seven. In fact, we've seen that so far in 2025. In the few weeks that markets have progressed here, we're seeing a narrow in that performance, the wider, more diversified approach benefiting. So we maintain a broader, diversified approach. We think that'll be the proper exposure over the long term, and we think earnings will begin to support that going forward. Now, an important notion to dispel here is that those mega cap stocks aren't completely speculative or not worthy of investment. And one way to measure that is to look at their earnings contribution. Now, specifically, we're looking at the weight of the top 10 stocks in the S&P 500. That's the dark blue line. And then in the lighter blue line, looking at their contribution to earnings. If you go back to the late 90s and right around 2000, you'll see that the earnings contribution fell well below their weight in the index. Whereas recently, you can see that the top 10 have really been a key driver of overall profits in the stock market and punching above their weight for a good portion of recent months in the past 2 years. But again, not speculative. You should have some exposure, but not to some of the large weights that are embedded in certain passive vehicles. So we urge caution there. And again, look to diversify holdings. Speaking of earnings growth, earnings season for the fourth quarter is just underway and tracking to a 10% earnings growth rate. If that maintains itself, we'll have 10% earnings growth for all of 2024. That's a very healthy growth rate and helps explain why stocks had another good year in 2024. As we look forward to 2025, the consensus forecast is for 14% earnings growth. We think that's a little too high, but even a result that came in the high single digits would still be very supportive for the equity market. So we do expect that to be revised down, but earnings, which are the key driver of stocks over the long term, still moving higher and should provide ongoing support to the stock market. Now, 2024 did not see much in the way of volatility. In fact, the maximum decline in 2024 peak to trough was 8%. That's below the average intra-year decline of 14% since 1980. A 10% correction shouldn't be a surprise for investors. That's normal volatility. We don't expect a recession in 2025. And just a reminder that outside of recession, big declines are very rare in the equity market. Here you look at the bigger declines, and some of the most severe are consistent with a recession. In 2022, a recession scare led to a sharp sell-off. But outside of 2022, you have to go back to 1987 and that sell-off, Black Monday, that led to a sharp sell-off in the equity markets. But again, absent a recession, we don't see a severe downturn. But again, do keep in mind that a 10% correction, very normal in the course of any given calendar year. Now, 2024 finished with a 20% plus gain. This is a rarity, and the first time since the late 90s that the S&P 500 was up 20% or more for back-to-back years. What's happened in prior occasions? Well, that's not a motive to abandon the equity market. In fact, when it's happened before, average performance has been good in the subsequent 3, 6, and 12 months periods. Here we take a look at all of those occurrences going back to 1943. Valuations certainly are elevated now, but you can see even excluding the go-go 90s, performance still strong on a 12-month basis, rising 9.8% in the year following back-to-back 20% gains. So a good historical precedent to stick to your investment approach. And we look at other technical indicators when we're looking at the equity markets, and one sign of health is to see consumer discretionary not losing ground to consumer staples and ideally outperforming consumer staples. And here a rising line means that consumer discretionary is outperforming consumer staples and vice versa. You can see in 2022 that steadily declined, whereas since the beginning of 2023, consumer discretionary has outperformed consumer staples. As long as this line is upward trending, that is a vote of confidence in the market, and the market is a good forward-looking indicator. This is a condition you do not see in bear markets and therefore provides an additional level of confidence for equity market investors. Let me change gears, talk about some valuation anomalies in the market. And I mentioned how the markets were very narrowly concentrated in terms of US large caps. Well, that's led to some big valuation disparities, which are starting to correct in 2025, but still have a long ways to go. This is the relative valuation differential between small caps as measured by the Russell 2000 index and the S&P 500. We're using price to sales here. And from a statistical basis, looking at the deviation, your standard deviation from the norm, and you can see that small caps are 2 standard deviations cheap, a historical rarity relative to large caps. So small caps, very cheap relative to large caps, and that's why you should maintain an exposure. Of course, large caps should be the bulk of your equity exposure, but maintain exposure in small caps. And similarly with international equities, again, following last year's disparity, international stocks historically cheap relative to US stocks. Now we don't recommend adding to those right now, given the lack of a fundamental catalyst, but we certainly wouldn't abandon that exposure, maintain it going forward, given that these valuations are very compelling. So two valuation anomalies in the equity markets, again, starting to see some reversal in these as 2025 is underway. And we are beginning a new presidential year. So stocks tend to do well in the first year of a new presidential cycle. Here we take a look at the S&P 500 in the first year of a new presidency. And in recent years, stocks have done better in that first year of a new presidency. In fact, as time has progressed, that first year has become more of a positive or stronger, greater magnitude outcome for investors versus years 2, 3, and 4. So a good sign for investors in the first year of a presidency, a new presidential cycle underway. That leads me to some policy items, which I think are certainly important for equity investors. Let's take a look at tariffs, and this is obviously front and center for a lot of investors as we begin 2025. And a look back at 2018 might be instructive. Here we show the timing of tariffs in 2018, along with performance of the S&P 500, emerging market equities, and developed international, represented by their respective indices. You can see that leading up to the first tariffs, international actually outperformed the S&P 500. We indexed this back to 100 at the start of 2017. And then once the tariffs were underway, the U.S. started to outperform. When we kept going, the U.S. started to outperform in those markets. But do note that in 2018, U.S. stocks lagged again, as other fundamental factors, specifically here, Fed rate hikes caused a sell-off in the U.S. equity market while international outperformed during that spell. The point is here, don't let tariffs be your driver of investment decision makings. All else equal, we expect tariffs to be slightly additive to inflation, but do remember that's on top of an already downward trend and could be a detractor to GDP growth. But there are a lot of factors that will ultimately determine the impact of any tariffs. President Trump recently announced just the other night that he'd institute 25% tariffs on both Canada and Mexico. He did announce also he wants to proceed with a 10% tariff on China. Again, whether these are actually implemented or more a negotiating tool remains to be seen. How much is passed on to consumers versus absorbed by companies or even offset by currency, and I'll talk more about that in a moment, really affects the impact. So impossible to handicap, lots of variables that we would encourage you to stay invested and not abandon investing just because of tariffs. Of course, retaliation is another variable to take into account as well. So we'll know more as the months progress. The markets right now not really factoring in too severe a scenario there. And important to look back at 2017 and 18, inflation did not increase following the first set of tariffs. And the big reason why is the stronger US dollar offset a lot of the impact of tariffs. So it's important to take into account the impact of currencies when assessing tariffs and what they ultimately might mean for the U.S. economy and U.S. corporate profits. So again, the implementation and the magnitude of any tariffs still a big unknown for financial markets, and therefore we wouldn't bank any decisions based solely on that. Let's move to fixed income markets, and treasury yields have been range bound over the last 2 years. Here we look at the 2 and 10-year treasury yield. Ironically, as the Fed began to cut rates, 2 and 10-year treasury yields increased. A bit of a rarity to see that happen. But the main reason for that wasn't inflation, but rather stronger than expected economic growth over the last few months of 2024. However, we don't see runaway interest rates. We see, as you can see on this chart, kind of a range developing for treasuries. At the low end, it's 3.5 on the 10-year. Maybe at the high end, it's 5. We don't see 10-year treasury yields exceeding that 5%, absent a surge in inflation, which again, we don't expect, or some other type of event that would warrant, or very strong growth that would warrant a bigger premium in the fixed income market. So we see yields fluctuating within this range. That should lead to better total returns for bond investors. Last year, about 1.5% for the Bloomberg aggregate. We expect better from that, simply from what we expect as a coupon clipping environment where investors collect their interests. We think bond markets are fairly valued now that the excessive rate cut expectations from September of last year have been priced out. This is the implied rate on the December 2025 Fed funds future, and it shows the market expecting the Fed funds rate to be close to 4% by the end of 2025. So that's just over another rate cut, 1.5 to be exact, as of now. We think that's a fair expectation. We do think inflation continues to decline to where the Fed can cut 2 times in 2025. And when we look further out in terms of the bond market, really not a lot expected beyond 2025. In fact, the futures market showing that they believe the Fed will stop rate cuts when the Fed funds rate gets to about 3.75 or 3.78, let's call it that range, and will halt from there. So a higher overnight rate, we're not going back to those ultra low rates or even a 2% overnight rate. We think that this is a fair expectation for bond investors, which again, if it stabilizes the bond market, as we believe it will lead to more of an interest or coupon clipping environment. Within the bond market, we are focused on high quality bonds. Take your risk on the equity markets because you're not being paid on the corporate bond market. This is the investment grade corporate bond market. The average yield advantage of investment grade corporates to comparable treasuries. You can see that it is well below the long-term average, near a historic low, in fact, and therefore compensation for taking corporate credit relatively limited. The same goes for high yield bonds. Compensation there is limited. And again, if you're going to take risks, do so on the equity side. We use bonds will, in our view, be a better diversifier on a go-forward basis. So that's our outlook for the economy and financial markets, more of a mid to high single-digit equity market return and low to mid single digits on the bond market. I'll pause there and bring on Rebecca Robinson, Head of Wealth Management.
All right. Thank you, Anthony. Thank you for a really thorough coverage of the market as we come into 2025. So we have some questions, and I always like to see the number of questions we get around a topic. And interest rates and interest rate direction remains a very popular topic. And we always like to stress, and you have a nice chart in there that basically shows a lot of this is priced into the market already. But when we think about those, 2 or so interest rate changes, a lot more tempered in expectations, how do we think about when they'll change, how they'll change, and then how is that already accounted for in what we see in the market now? And what kind of change would be required for that to really dramatically deviate from what we expect?
Sure. So, when you look at what the market expects the Fed to do, it's 1.5 cuts as of today. We think, we'll call it 2 quarter basis point cuts are certainly going to be reasonable with inflation slowing. As of now, the market does not see a Fed rate cut in January. They expect to pause, and the Fed's telegraphed that just as much. But very likely we could see one in March, especially if we get additional good news on inflation like we did last week. The intermediate part of the bond market, I think, is fairly priced for those rate cuts, Rebecca. I think where you'll see some continued movement is in the very short part of the market. So, for example, we have investors that are content to sit on cash, not realizing that 2 rate cuts is going to lead to a 0.5% lower on those rates. So those will move along with additional Fed rate cuts. And then really, what do we see that would change that? We need a lot stronger economic growth or higher inflation to basically have the Fed not do any rate cuts. Or we'd have to see some sort of recessionary or economic weakening to see more than those 2. I think it's possible to maybe get 3 rate cuts as the Fed funds rate will be above the inflation rate. But I think 2 is fair, and I think that means that intermediate rates are right where they should be and is fair value, but look for those short rates to keep coming down.
Nancy, I want to go back to something you said. In the last couple of years now, we've seen rates on cash go up, and in some ways they've actually outperformed the fixed income market in certain areas. So people are sort of keeping that cash, but almost as an investment. And there was a question about what to expect in deposit and CD rates. 2025 and 26, but also I think this is worth really digging into is how quickly those types of rates move when there are adjustments.
We'll see those short-term CD rates come down with Fed rate cuts. It takes about 45 to 60 days for those rate cuts to work through those short-term vehicles. So the last Fed rate cut here in December looks like it's almost fully priced in, but you might see an additional creep on some of those money market funds as they have to recycle those maturing investments at lower yields. So Takes about 2 months for that to fully work through. But yes, those short-term CD rates, short-term interest rates still coming down in our view.
Perfect. A lot of people have been sitting on the sidelines because we also saw an increase in the cost of housing as well as an increase in mortgage rates. And this question is about what is the relationship between the bond market and 30-year mortgage interest rates?
If you need one indicator to track mortgage rates would be the 10-year treasury. There's also the yield differential between mortgage-backed securities and treasuries. Doesn't fluctuate a lot, but there's a little bit of movement there. So if there was some trouble in the mortgage market or investors were hesitating, the 10-year treasury yield wouldn't fully explain the change in mortgage rates. But historically, it does move pretty close to the 10-year. So that would be, for me, the one to watch for our investors out there.
All right. And talking about housing, you talked about how really the increase in housing prices has also really fueled a growth in net worth for individuals. If someone's thinking about buying or looking at the housing market, what do we see for the housing market in 2025? And does the new administration, interest rates, things like that, do those have a more immediate impact on housing prices?
Yeah, I think, the mortgage rates being up around 7 has really put a damper on the housing market. At the same time, supply, at least in residential housing, is still very tight. It's increasing, but not enough to really move the needle. Our view is, as far as the eye can see, the residential real estate market, and you could extend it to other sectors of real estate as well, not really going to see much in the way of price gains going forward. We still have positive year-over-year price increases, but we see this as a really low growth area in terms of prices for a while, because it will take a while for that lack of supply to change. And at the same time, interest rates are really restricting new buyers. So, and underneath all that, I think are healthy fundamentals. We don't have a lot of speculation like we did in the 2000s. So I think it's more of a really slow moving market with limited upside on a go forward basis.
Yeah, and I think it's worth repeating that it really is about supply, where there was a lot more speculation, a lot more second homes, things like that back in 2008. Interesting, the chart that talked about how stocks do better in the first year of a presidency. And then with any new administration, there's a lot of talk also of new policies and questions around what changes will the new administration make that will affect the market, and what effects will those be? And I always think it's also worth really saying, are those long-term fundamental effects, or are those maybe intermediate or short-term impacts, and how do we think about those?
Yeah, so I think 3 areas really to focus on in terms of what the new administration might do to impact both the economy and financial, and in part the financial markets. So the first one will be, of course, tariffs, which we mentioned. Lots of variables. All else equal, tariffs will lead to slightly higher inflation and restrict economic growth by maybe a few tenths of a percent, maybe more. So many variables there, as I mentioned. What is the ultimate tariff rate, if any? What is the pass through to U.S. consumers? Do other countries retaliate? It's really hard to handicap that. That's one. Two would be extending the tax cuts from the TGCA back in the first Trump term in 2017. That's widely priced in, and I think has played a role in the equity market strength. And the third would be immigration. To what extent is immigration curbed? And immigration was a key driver of an increased labor supply pool, staying away from the argument of legal versus illegal, but that was a big driver of increasing the labor pool, and therefore also leading to economic growth as well. There's several studies that say if you restrict that growth, it could be damaging to the economy. So those are the 3 areas. My big caveat, and we've talked about this before, is that ultimately the policy doesn't have that big an impact on the equity market. It's about corporate profits, which really drive from the consumer and businesses, and they aren't going to be fully impacted from those three components, Rebecca. So we yes, take note of them. They might be more industry specific rather than more broad based. Wouldn't base any investment decision on that, because historically we've seen that policy doesn't have much impact on financial market returns.
That's perfect. So here's a question about risk, and it's a very broad one. What is your biggest concern for 2025, and what are the odds of it happening? I want to say your biggest concern in the markets.
I think it's concerned. Well, I think tariffs would be one. I think geopolitics is another. I also think the growing treasury debt and the interest expense, the supply of bonds that we need, especially in the light of extending those tax cuts, how does that impact the markets? But that interest cost is a very slow moving one. I think that could be tolerated for a few more years, but those are kind of the risks that I see. But I always stress to investors, it's the risks you don't see that really end the market, because when it's known, it's quantifiable, people can prepare for it. It's things that come out of left field that really catch the market and create problems, like a COVID. People spend a lot of time worrying about that, Rebecca, but it's impossible to really forecast that, and therefore it's the risks you don't know about that the ones that likely create problems.
And I think it's also fair to say when we've had those shocks to the system, we then subsequently see some of the best market performance following them. So it's the importance of a long-term plan, something that can ride out those waves, but that you're not in and out based on either risk that we can see or the risk that we can't see.
Right.
Cryptocurrency has kind of come back in. We talked about it a lot 2 or 3 years ago. Then it's kind of fallen out. But I think with some of the new administration and media, questions around kind of what do you think about silver, and this one's Bitcoin, but I think we could maybe talk about cryptocurrency in general.
Yeah, I think for crypto, it's enjoyed a bit of a renaissance in 2024, especially with some of the institutionalization of it with ETFs, crypto ETFs coming out. We don't include it in an investment program. I think if an investor wants to use it, do so separately out of a diversified investment portfolio. I still view it as highly speculative. The big price swings up or down aren't something you'd want to include in a diversified portfolio. It has no earnings, there's no interest, really hard to value, and it's just dependent on someone paying a higher price. So we view it as a highly speculative instrument. Don't include it, that or precious metals, in a diversified portfolio.
Good. And then one final question on just general investing. It's really around which sectors do you like in 2025? And you talked about the tech sector, but I think it's important to note, even within the technology sector, it's highly concentrated in a very few companies. So how do we think about sectors as you're building a portfolio? And do you ever advocate leaning toward a sector at any given time?
We really don't. We keep it fairly diverse. An interesting stat is, I don't think most investors realize, the broad technology sector outside of those big tech companies actually has underperformed the broader S&P since July of last year. So under the hood, even tech has seen some weakness outside of those big names. In any bull market, you'll see different sectors lead. Historically, there's never been one dominant sector in a bull market. So I would caution against trying to pile into one sector or not. We really believe in being diverse and focusing on those companies that are going to drive earnings consistently over time. Again, too much variability in sectors over time as to which one will lead. So have a balanced approach.
And I think that's our theme overall. Have a financial plan, take a balanced approach, and make sure when you're investing that you're investing in a way that you can stick with it long term and that it's tied to your goals and objectives. So while we take all of this information in, what's also important that it is overlaid over your long-term plan. So Anthony, with that, we want to thank everyone for joining. You will receive a survey at the end of this. We appreciate it if you fill it out. We read all of them, and we do look for opportunities to take on new topics. And then also, if you need help personally as you're kicking off 2025 and financial New Year's resolutions, you can also indicate if you would like to be contacted, and we will have someone reach out to you. So with that, thank you very much, and thank you for your participation.
Thank you.